Welcome to the podcast and video. Live with me is full-time investor, equity analyst, Paul Hill. You all right, fella?
Yeah, morning, Justin.
Do you know what I noticed? We keep saying, are we at the bottom? Is this the bottom here? Is it going down any further? Now, I did look at the markets last night, especially the S&P 500, and it's in this trading range, pretty much between, the low was like 3,900, and then it needed to break over 4,100 to break that range really. And now it's rolling back over. So it's had that bounce, and it's rolling back over a bit. Now, I think people are worried about maybe the ECB, so they're going to raise rates. They're behind the curve a bit, aren't they? And then there's the CPI figures out and all that stuff. What's your thoughts? As far as I'm concerned, someone asked me, what's going to stop this rolling over? I said, well, first and foremost, the death of Putin. That would help a lot. But short of that...
That's not going to happen, is it?
I know. Short of that, maybe, the war in Ukraine stopping would help. And then I thought about it a couple more times. I thought, well, maybe the inflation figures not getting worse would be good. But essentially, at the moment, to bring energy prices down, I think a recession is the most efficient way of bringing those down. Because at the moment, they keep. So I keep looking at the gas price and oil price every day, and they seem to be hitting new highs every single day. And I'm thinking, what's going to bring this down?
Yeah, there's plenty of things, catalysts, that if they do turn, which are unlikely, then we will get obviously a positive bounce. But there's a lot to unpack there. You started off with the ECB. Obviously, they're suggesting they're going to raise interest rates a bit, obviously behind the curve. What's that going to mean in terms of the sort of Club Med economies? But the real sort of like big macro issue du jour today, and we're recording before it comes out, is the US CPI print, expecting about 8.3%. It compared to a peak of 8.5%. And I think where the markets, you talked about the US there, what happened overnight? Well, it took a bit of a bath. It went down 1% or 2%, etc. And that was, it's difficult to know, but it fears that it's going to be, the inflation number is going to be higher than the expectations. And I think that could be partly because yesterday morning, the Chinese, it depends how much you actually believe it, but their export data absolutely shot up for May, meaning that, who's their biggest exporter? It's the US economy. And it looks as though they're still sucking in a lot of demand. And if you still get sort of like goods inflation, then you're still going to get a lot of, and you couple that with the energy inflation as well. And obviously in the States, they've got a boom in services on top of that. Then if you put all that together, it could well surprise on the, to the upside, which means that then the market is going to start thinking the Federal Reserve is going to lift interest rates faster than even what's priced in currently. And it's a difficult situation because the Federal Reserve is in a bit of a box. And I haven't heard this discussed a great deal in the markets, but it's one of my sort of like, bugbears. Is such, or risks, etc. President Biden has obviously got his boot to Jerome Powell's neck at the moment at the Federal Reserve, and he's sort of like pushing him into a bit of a box. And there's sort of like Biden is saying with his really strong rhetoric that it's the number one issue for the American people in higher inflation. He's got to bring it down, and having obviously the Federal Reserve sort of dropped the ball on the transitory inflation call 2 years ago, and now the president's on his back, really on his back, then is he going to basically come into a policy mistake and lift interest rates faster? And the jury's out on that one to a certain extent. But if we do get a higher inflation print, it could actually scare him a bit and scare the Federal Reserve into action. And that's where the market is saying. So then coming full circle to what your question is, have we reached the bottom? Well, that is really interesting, actually, because you and I have noticed, being investors, that actually bad news, sometimes the share prices now are not going down as far as they were. So yes, it's a really, really nuts situation. But my instinct is saying today is that actually the economy could roll over, and I'm more along the lines of now we're going to get a slowdown, and not so much a slowdown, but a shallow sort of recession next year. It just feels that way. coming off sort of high growths in 2021 with the high energy prices and I think the war in Ukraine isn't going to end anytime soon. I really was hoping it would do. And as you rightly say, that's going to keep, the oil price sort of 120 a barrel. So my economic view has actually deteriorated over the last sort of month or so on the back of that. I think, we're going to get higher inflation for longer, which is going to spook Jerome Powell and force him to raise interest rates, which is going to push up bonds. And then, it's going to slow down the US economy, the world's biggest. It's also going to increase the yield, sort of like carry trade for currencies. So it's going to force the ECB to lift up interest rates and the UK to protect almost their currencies, because if they devalue too much, then they're going to see accelerated inflation. So in the developed world, I think we're going to see tighter. So my economic view has deteriorated. But equally, when it comes down to your really nuts and bolts and bring it down to sort of like, you and I as investors, is the market or anticipate? Well, that is fascinating, because there's so many professional, investors and fund managers who have gone largely to cash, and you're starting to see that. I mean, I've got a company, I've talked about it 2 or 3 weeks ago, Aviva, which is a digital sort of like software business that does digital twins and helps industrial companies. Came out with a pretty so ho-hum type of set of results this week. And the shares were up 10%, largely because they're starting to see orders come in. But the shares aren't cheap either. They're about 5.5 times sales. And obviously, as an investor, I'm delighted. But what that's saying to me, actually, because you've got a lot of really smart guys going to the sidelines having cash, they are looking to deploy funds going forward. And they're sort of trying to sense, they're trying to time the market, basically. When is it going to reach the low? Mm-hmm. So I think we've got this nut situation whereby my economic view has deteriorated. But actually, I think we're in small cap land in particular, and some air pockets of tech, etc. We're reaching a position that there isn't going to be that much downside unless we see a really deep and protracted recession, which I don't think we're going to get. So that's a long way of saying I still feel relatively upbeat about going forward.
Yeah. Well, the funny thing is, like you say, I saw there was a poll on CNBC's watching it. They questioned over 100 CEOs, and I think the vast majority of them see a recession happening. But conversely, like you say, that would bring that'd be the most effective way of bringing oil and gas down. They'll tank, and that will help growth. And I saw a quote. Someone said, "What they want now, it's between a rock and a hard place here. They prefer recession than stagflation." And that's it. They can't control that. So they still want growth there. And what's worrying is, did you see this OECD figures about the UK, having no growth? And
the World Bank, yeah.
Yeah. And what you don't want is an economy with high, prices and no growth. So I think now, there's a lot of pressure on policymakers to try and stimulate the economy. And in fact, you can see it's a discrepancy between Rishi Sunak here and Boris Johnson. Boris Johnson being under pressure. Probably going to say to Rishi, we got to get this economy growing. I want to beat those OECD, I want to show the World Bank and the OECD that they're wrong. And so I think, but I think, like I said, the worry about a recession, bringing down the price of energy, oil and gas, will help in a certain way, because it's not coming down. That's harming everything, So
it's an interesting one. That again, that would be the logical economic view. But frankly, I actually think what you've got, again, another one of my bugbears, as much as anything, is that the Federal Reserve and all central banks, certainly in the Western world, look at core CPI. Okay, now core CPI strips out energy and food, right? Yeah. Which you and I and consumers can't avoid, right? So we actually behave and react on normal CPI, but they react on core CPI. And okay, I can get it in terms of their mandates is to bring inflation back to 2% in the medium term. So they try and strip out this transitory effect. Well, they got that wrong, didn't they?
Yeah.
But so eventually you've got these central bankers, really smart guys, who are basically operating on core CPI, stripping out what you and I and then the dog have to do, basically. But we and 70%, the economy, all the consumers and certain businesses as well react on actual prices, including, what is our biggest cost, frankly?
Yeah, the biggest contributor to inflation. Yeah,
it's food.
It's
It's food, groceries, and utility prices, and certainly with the petrol, tank now at £100 to fill up, etc., up about 30% year on year, and energy prices for domestics up 50% or well over 50%. Your gas and your electricity bills, etc. Then we react and behave, and we start sort of like drawing in sort of our expenditure in certain non-discretionary areas, and you're seeing that already with sort of like kitchenware and all that kind of stuff, homes and this sort of stuff. So we react on the behavior, and that is where you then start getting obviously demand destruction, etc. So as a consumers, we react to these total inflation. So when it comes to your sort of observation in terms of oil and gas, etc., I actually think what will happen with oil and gas is such that, until there's a resolution in the Ukraine crisis, you're still going to see, even if you get demand destruction, you're still going to see pretty elevated oil and gas prices. And so you got that sort of like really gradual reduction of inflation from its peak levels, and it's going to peak in the UK. We know, we reckon, sort of by the end of the year at about 10-11%, etc., according to the Bank of England, and then how quickly does it go down? So that stagflationary sort of like scenario is likely to last longer than people expect, etc. And what I think will happen actually is such that, because you've got this sort of sticker shock and a lot of, that will basically, reduce demand for those areas, and you'll get a lot more substitution in terms of other things to do and buy. And, that will leave it such that maybe the central banks, ultimately, they might go up sharply in interest rates to choke off this because they've got President Biden on their back. Yeah. But then they'll have to start reducing in late 2023, 2024. Because
that's it, isn't it? I mean, a lot of people see these hikes as going one way, but like I said, I think they'll probably be faster to reduce, if they say things going the wrong way, So,
because because the consumers are going to do all the heavy lifting for them. Yeah. Because essentially what we're doing is cooling inflation by substituting in other areas. And let's be clear about it. It isn't all bad news, because people are still going on holiday. People are still spending. The spend is moving from goods to services. Just look at the sort of increase in credit card stuff. But there is a large part of the economy, most of the economy, in fact, which is seeing a decline in real wages or real income. And on that basis, you're going to have to turn to all the disposable savings you made on COVID. And if you haven't got any, then you're really going to sort of like, sort of struggle.
It's nuts, isn't it? That core inflation is nuts, because the main thing people are concerned about is energy. That's the base case. Everyone uses energy. Everyone has to use energy, from individual to businesses. That's what everyone's talking about, and food prices, and yet it's not included. It's like, even yesterday, me and the wife sitting there, we're looking at our bill, and we're saying it's going up to it's more than doubled, our forecast, our bill. And we're thinking, okay, we're trying to look at fixing it. And it's nuts. My thought was, how do people afford this? How do people really struggle to afford this? So and that's the main conversation everyone's having.
But the point is that will drive the economy, won't it? It's consumer and business behavior, how we react to effectively all of inflation when you put it all together, including gas and electricity and food, etc., into product. How we react will then drive the economy. And then essentially we'll do most of the heavy lifting for the Bank of England, for effectively the central banks, who strip all that out and just look at it longer term in terms of the medium term, and just look at it on a core inflation basis. And you're actually starting to see some, decent green shoots, if you can call it green shoots, is that, a lot of the big tech companies have already said they've overhired during the pandemic and are starting to have a hiring freeze, recruitment freeze, or shed staff, people like Tesla, Facebook, Amazon, these kind of guys. And that should help at least try and balance the labor market. But I think technically and maths wise, we are heading for a recession. And I'm hoping, and I think it will be, a shallow recession. And that's the soft landing rather than we're going to avoid a recession full stop. We're just not, I just can't see how we're going to avoid that. But I don't think yet we're going to get that deep protracted one, which would take the stock market down further. But as I say, this is the key. And you asked it straight at the start. You're right on the button here. What's that going to mean for the stock market? Well, I actually think the stock market has seen this one coming. And a lot of the areas, we've already had a lot of smart people who have gone into cash and will buy these knockdown areas once they start seeing actually the deep protracted recession is off the cards. Let's put some money to work. And that's what you've seen as I say, in Aviva last week and lots of others are small caps.
Yeah. But no, I mean, it came back to when someone asked me about what's going to turn the market around. I said, oddly, a recession, because rumors of a recession, that happening will be negative for oil and gas. That is positive for everything else, pretty much. So, and it's one of the things that, don't be afraid the R word when it comes to stock market, because like you say, markets tend to rally way before a recession because data is backward looking, and so the markets tend to rally through that, beyond that, before that anyway. Okay, let's look at the individual stocks. What do you want to start with? I know it's one of your stocks that you hold. Was it Northbridge? And it's a nice little statement, didn't they?
Yeah, well, I think we both did well on that day. We'll come on to yours, but Northbridge. I mean, what a top AGM trading update, saying they're increasing expectations. Just to give people, investors, a bit of flavour. What do? They do these premium load banks that are used to test and commission backup power supplies. And why is that market increasing? Well, I mean, frankly, you've got three enduring secular growth themes driving it. First of all, data centers, which is digitization. You've got this energy transition to renewables. And then finally, because you've got that, energy transition and the critical sort of like nature of a lot of sort of the data centers, you get in network unreliability. So you're getting a boom of sort of like, backup power supplies as well around the world. And essentially, those are just going to be 10-year trends that Northbridge, soon to be called Creschick load banks or Creschick, is being driven. That's growth is being driven, by all three. And they've got so much demand, they haven't been able to meet it over the last few years. So they've just brought on stream. It's starting to produce now. Their new factory extension facility in Burton-on-Trent increases capacity by about 60%. So they've just got in a fabulous position, much higher, stronger demand, pricing power, and increased capacity. I can only see further management upgrades unless something happens in terms of really sort of like knocking those secular. I mean, can you really see electrification, digitization stopping? Well, I mean, yes, if you get a world war, potentially, but I can't see it. It's going to carry on. In fact, if anything, it's going to accelerate because of the Ukraine-Russia crisis. So on that basis, they've got a really long-term growth trajectory. I could see the shares, they're currently just ticked up over £2. I could see them well over £3 in 12 months' time, largely on the back of upgrades and, utilising that 60%, factory capacity. Their biggest problem is basically their supply base. Can they ramp up their suppliers to be able to give them the parts to manufacture and the load banks, such they can then rent them out or sell them to people like for data centers and stuff like that? So they're in a brilliant position. There's obviously an execution risk associated, but the management team is top notch. They're doing a fabulous job at the moment. Sales are increasing at sort of like 15% plus annualized. And it's good margin, and they're improving their return on capital employed, and their customers are some of the biggest guys in the world. So they'll either get to, in my view, they'll either get to over £3 organically, or they'll get bought out by £3 or £4. So I just think they're in a really nice spot. They've got a niche, so they've got about 10% of the market. They've got, you know, say pricing power. They're improving their internal efficiencies as well, so margins are improving, and they've got a really good sort of management team who seem to be doing a terrific job. And now they're very focused on just it being, you know, a renewable, load bank business. So, you know, because they've sold to Tasmanoff. What's not to like, eh?
Do you know what? And that's contrary. If you look at the AIM all share chart going back to July last year, perhaps, or September, right? It goes up, then comes down. If you flip that chart, spin it around and go the other way, that's Northbridge. That's against the current of all AIM shares, you know? And so that's nice to see. There are some out there, you know, bucking the trend and still growing and going upwards. Not many, like I said, I think the AIM all shares down 26%. In fact, it sort of bounced a little bit a few weeks back, but it's now getting close to its lows again, which is a bit worrying. But
well, I mean, the other one I've been banging the table to you for 2 years, along with or more than that, 2 to 3 years, along with Northbridge, is Equals, isn't it? As long as we've been chatting, and that's the other one which has beaten AIM, you know, handsomely and generating enormous growth and got a great technology platform. So I've just been quite lucky that 2 of my largest positions have brought stability to the portfolio. And yes, I'm sort of like slightly down from all-time highs, but actually this year I think I'm pretty much flat, you know, sort of stuff. So not a bad effort, really. Well, anyway, that was obviously, I'm delighted about Northbridge. I think they're going to do really well. If I'm a reasonable large shareholder in it, I'm just going to keep holding it. So, you know, I mean, but I think there's another 50% going in the next 12 months. If I didn't own it, I'd be buying it, but I've got a big position, so I don't particularly want to add to it. Likewise with the Equals, I think Equals is going well above £1. It's just a matter of when. But that's my biggest position. You don't want to sort of overstretch yourself. So anyway, coming on to your good news on the same day.
Yeah, but you know what? And also chart-wise, I was looking at this. I mean, it's had a few dips, but the only one that's pretty much bucked the AIM trend in my portfolio is Trufin, and that's that. I mean, that rose was going back to September last year when the market AIM all shares started to roll over. This went from like 20 pence up to 80 pence, pretty much, and then it's basically gone flat. In the sell-off that AIM's had, so it's flat. So at least it's held its valuation there. But it is nuts. And I did say yesterday on Twitter, I said, here's a company, right? It fall past the Trufin, Sartago and place like a very sexy growth areas yet to unfold. The story's unfolding slowly. But it's 80 million market cap. There's 4 companies there. Sartago came out yesterday with a deal with Lloyds and Sage, 2 FTSE 100 companies. Now, it's a software as a service company. If you set up that company and you've got a list of dream partners in the UK, those companies will be up there. And I've seen, on AIM, I've seen companies announce deals like this in a bull market and double overnight. Yesterday, the 7%. That's unbelievable. You couldn't get a better deal than that. But I mean, how I understand it is, they were partnering with Lloyds, using Lloyds' loan book. And now Sage has come on board, and Sage is going to work around the world using other banks. So Lloyds just using the UK, and they go around the world, and Sage will partner with other banks who will use their loan books around the world. And I think it's phenomenal sort of validation and endorsement of best-in-class software. But it moved 7% yesterday. This is nuts. And like I said, 80 million market cap. If you break it down, I mean, they're not equally valued, 4 companies, but 20 million each, which is ridiculous. In fact, James had Oxygen, which has now got, I don't know if you know about Oxygen, but describe what they are. They're a leading provider of early payment systems to public and private companies, but their contracts are like minimum 5 years. I think 98% of their contracts are renewing all the time. It's phenomenal. He says that, honestly, the forecast revenue, you have that with very, a strong visibility going forward. That pretty much underpins the valuation of Trufin going forward, let alone Virtus, Playstack, and Sartago. And if you look, it's hard to know. They're going to be coming up with figures end of the year on what they think they'll be generating from Sage and Lloyds. But even on the Lloyds deal, like I said, the brokers forecast mid-range. So they break it down into how many subscribers they get, subscriptions. They go from 10, 20, 30,000. Then they go from 50 to 100, 150, 200 per month. And if you look at £100 per month, 24,000, they're generating about 24 million in revenue, Sartago alone. They own 68% Trufin. So that's worth, on those figures, about 163 million in value alone. That's double Trufin's valuation. So of course it's early stages, but
so how did you get the value of that?
So they reckoned that they've got
24 million sales, right?
So yeah,
okay.
so 20,000.
Yeah, okay, and they own what, 70% of it?
Yeah, 70%.
Okay, so let's just do that. So we've got so 24 million, 70% of that is roughly round about what, 16 million of their turnover, and you're saying it's worth 10 times sales to get to 160 million.
I think that, yes, they're saying 10 times sales on that. Of course,
it ain't worth 10 times sales. Not for that type. It'll be 5 times for that sort of stuff. But it's still a big number. Don't get me wrong. It ain't 10. I personally wouldn't say it's 10 times. I think that's quite a racy valuation. But that's subject to opinion, because when you think about it, right, this is now best-in-class software for they're rolling this out globally. Sage are taking this on, rolling this out globally, as are Lloyd's. I mean, the potential is very big, and especially in an environment where people are having issues with late payments and all that stuff. This kicks in massively. This plays into a slowing economy. It really does. And well, that's what the brokers are saying. But even if you halve that, you say 5 times sales, then you still get 80 mil. You still get 80 mil.
That's the valuation of Trufin, yeah.
Yeah. No, you still get 80 mil. I mean, I don't want to diss it because it's a fabulous deal. No, I'm just trying to say, put a reasonable, you put that on the lens, it's 80 million of additional market cap just on potentially of this deal, which is which you're right, would have come back to your original comment, would have doubled the shares in a bull market.
Yeah. And but let's say even if you do 5 times sales on that, like you said, that's the value of Trufin. Now they've got PlayStack. I don't know if you saw PlayStack this week. They bought a very clever deal. They bought a company called Magic Fuel. Now, Magic Fuel, the people behind that, do you remember? I'm not into games, but even I remember Sim City. These were the first simulated cities where you create communities, environments. Advertising opportunities are massive within these areas because they've got billboards everywhere. And PlayStack also have in-game ad tech, which they're just about to launch. Their beta testing is going very well. But I think they've also, it's very clever because they announced simultaneously a deal with a global technology partner. Now it's going to be sort of Microsoft, some of that, because that's who the last deal they did with Mortal Shell, which was sold 500 million units. So 500,000 units. Sorry, it's a big hit. One of their games in their studio. So they knew this deal was almost on the cards there, and they bought Magic Fuel to generate another one of these games launch next year. And I think this is going to be massive again. So it's funny. It's a target. It probably underpins right now the valuation of Trufin. And you got Oxygen, which is profitable. Virtus is profitable. PlayStack is going to be profitable next year. In fact, they're funded to profitability. So yeah, I just say a bear market is a very good time to research companies, because in a bull market you can see good news coming out and the share price spike on certain things. It doesn't happen in bear markets. So you can take your time researching a company and really think, like I say, there's some good companies out there worth researching, and you can take your time, absolutely take your time, because it's got a long way to go. By the way, this is not an exclusive deal with Satago, and so they're still chatting to other people as well. So you may hear Sage announcing other banks around the world they're partnering with for Satago, but also there may be deals outside that as well. So it's just it's panning out nicely, and the story is getting more exciting, I think. Absolutely,
Oh yeah, no, I mean, I think that let's be clear about it. It's got a lot of value drivers there, hasn't it? So it's just a matter of sort of kicking in.
Yeah. I mean, hopefully, I'm going to chat to James. He wants to do a podcast end this month, so hopefully, you get some more information on that, because when you work with big companies like this, you've got to work to their time frames, and they don't work as fast as small AIM companies, of course. But so hopefully we'll get more information on this. But it's good news. Absolutely, you couldn't get better news, could you? In fact, I didn't realize that when you talked to what's his name, the guy from Mighton, Gervais, they bought it for £1. Satago.
Yeah.
Thinking, that's phenomenal, is it really?
Yeah, no, I mean, I would say that that looks a terrific share, and it's one to hold, isn't it? Because there's lots of good value drivers. I mean, another company that I've talked to you about that is in a similar sort of situation. It releases excellent news and excellent results and a good strong outlook, but in a bear market doesn't react. In fact, the consumer is just in a really anything in the consumer sector is getting hit, which is Marks Electrical. And they came out the industry suffering, no doubt about it. The likes of Currys and AO World, etc. I mean, just to give you, they're a sort of digitally native, i.e. all online, supplier of sort of domestic appliances, televisions, fridges, freezers, cookers, etc. All lots of premium product, etc. And their customer service is absolutely great. In fact, I've just bought what is it, basically a dishwasher from them as well. So I'm sort of testing and kicking the tires on it. Yeah, I mean, they came out with some really, really strong industry beating results. Sales up 44%, and the brokers are still saying they're going to do sort of over 15% like for like growth next year, and it could be a flattish market, even if down market in totality. They'll continue to win market share, but they still have very small market share, 1.6%. The CEO and founder, Mark Smithson, is trying to get that to 10% ultimately. So there's plenty of upside. And he's absolutely knocking the ball out park compared to the sort of the major competitors. And you can see why, because the customer service next day delivery that they do is absolutely great. They've got a lot of tech in their systems as well, in terms of giving them some sort of, you know, competitive insights, etc. And their Trustpilot score is actually is the highest I've ever seen. I've never seen one, which is 4.8 out of 5. So, you know, lots of consumers love the service and are recommending, endorsing to friends and families, and, you know, first-time users, first-time households are becoming repeat customers as well. So you've got that sort of snowball effect of viral. They've got good, solid. They've got industry-beating margins, generating cash. They've got cash on the balance sheet, so they're in a perfect place. But hey, even if you put out, you know, lights out type of, you know, results in a down market, then they're still, you know, the shares will go down. They've gone down a lot less than anybody else, and they will come up. There's no doubt about it. But they are a best-in-class performer across the consumer complex, and certainly in that vertical. And the shares are going to do well ultimately. But at the moment, it's like pushing water up a hill. You've got no chance.
Well, that's it. Like you said, off the back of that, you know, and like I said, now is the time to do good research on these companies. Like they get lumped in with other sector peers, but they're not like other sector peers. Owner operated business, very proud of his business. He's not a manager that's brought in, paid a high salary, and got share options everywhere. This is a guy that's, you know, founded the business. He's down on every bit of detail in that business, and is very proud of achieving, you know, good scores, and that's his driver. But this is the time to look at something like a company like this and realize, in fact, you know, it's his head and shoulders above peers. And if you want, you know, exposure to a good company, knowing it'll take a bit of a hit in this environment, that's a good time to get research, isn't it? And find out about it and knock the numbers through and look at the quality there, because you know, you don't get these opportunities in bull markets. It doesn't happen. So when the entire sector starts to go up, this should rally faster than the rest, because it's obviously.
Yeah, I mean, I think the brokers have got a price target on of 150p. It's currently trading at about 90. So even in a down market, they see plenty of upside. I mean, I would say likewise, I put it in the same box. No news, and that's a bit of a pun. His old cake box. You know, you've got Suk Chamdal out there, the CEO and founder, and the shares have dribbled back to 190, but they're still doing really well. Franchise of sort of like, you know, premium egg-free cakes in the UK. And likewise with Lord's Trading. I mean, they're growing twice as fast as their largest competitor, Travis Perkins, in sort of like, you know, repair, maintenance and improvement for the UK, and that sort of like, you know, helping, you know, sort of houses, etc. And they're just in a down sector, and they're putting out some pretty good results. So I'm with you. You know, if you go with these founder businesses that the guys are really still passionate, and the other one, of course, yeah. I mean, I keep forgetting is Revolution Beauty, which is headed up by, you know, Adam Minto as well, and that's come down. And that was again another one which is really interesting, because actually the sector's doing pretty well, as in sort of like, you know, people are going out across the world, particularly in the States, using more cosmetics. These guys have got a fabulous challenger brand. They're growing faster than any, you know, the most others. Even people like War Paint Cosmetics are doing well. And, you know, I think these guys will do, but the shares have sort of like, you know, come off and been sold off, you know, too much. So, yeah, I mean, and they're now less than, I can't believe it, they're now less than £1, you know. I mean, it just is nuts. So, I would put them all into the same bucket: Marks Electrical, Revolution Beauty, Kate Box, and you know, sort of Lord's Group Trading. Really strong founder businesses, passionate and energized, and entrepreneurial team spirit throughout the whole organisations.
Yeah. Do you know what? When I was away, we had one of my, in fact, I think it's my largest holding, had results from XP Factory, and great. But
Boom, boom.
Yeah. But boom. But do you know what? It's odd because these are largely figures from Escape Hunt because they acquired Boom Battle Bar end of November, and we know end of November there's pretty much a lockdown, so there's hardly any figures for that. But on Escape and alone, and of course last year was lockdown as well until April, so you're not trading on a full year here. But even so, group revenues up to 7 million. That's 163% up. And EBITDA positive 2.7 million. And the thing is, if you look at next year now Boom Battle Bar starts to kick in, and they'll have they had one owner operated at the end of the year, before December, and 6 franchisees, I think. By the end of this year, they will have 27 Boom Battle Bars, 7 owner operated, 20 franchisees. And the revenue is going to be up to 25 million this year from 7 million. And you're talking about EBITDA margins above 20%, so very good. And even on top, so that'll be a 250% growth top line. And then next year after that, that's another 50% growth on top of that. And they're saying over the next 5 years, they'll be having 50 Escape Hunts, but 100 Boom Battle Bars. And they are saying the fastest growing leisure business in the UK. I've had a couple of people say to me, are you worried about people, tightening their belts? And I say, for leisure, people still go out. I can't remember even the worst recessions. People still go out and have a meal, go for
Yeah, I totally agree. I mean, if you go out, you've done it. You kick the tires on it. If you go out to either an Escape Hunt with a family of 4, or your friends, family of 4, or to a Boom Battle Bar place in an evening, or how much are you going to spend? How much is it going to cost you?
I think for about £20 for Escape Hunt, it's about £20 per person, I think. So it'll cost.
Okay, so that's really reasonable.
Yeah, yeah, exactly. And it's not the kind of people think. I think they think like it's something you do every week. No, it's not. People don't do this.
Yeah.
Is it? There's enough people in. It's like cake box. There's enough birthdays in the country.
Yeah. No, 20 quid. I mean, 20 quid a head's nothing, is it? I mean, if you're spending 8 quid on a pint of beer down a flipping pub in London, I mean, 20 quid for a night out, it's entertainment is naff all.
And of course the efficiencies get better because they have co-located sites as well, and the operational efficiencies get better.
What about Boom Battle Bars if you go for an evening out there and start throwing axes around?
Well, I don't know yet, but I'm going to want to say, but I think they are. I think they're about £20 a game. I think pretty much on the games, and that is food and drink. They're like normal. So yeah. So it's not
okay. So that's slightly more expensive anyway.
Yeah, but it's a younger clientele there. I mean, they're looking at people generally, not just students, but young people going out and all that stuff. And it is like a special occasion kind of thing. And there's plenty of special occasions, corporate events going on to sustain this business profitably and make it grow. It's not the kind of thing where you go every week or a couple of times a week. It doesn't have to be like that. So yeah, it's a special occasion thing, and if you're going to go to a bar now with a few mates and want to make a bit of a change, where do you go? Just sit down the pub, or do you think, or just go for a meal, or do you think, there's a new thing in town? Let's try that. All go out, crazy golf, virtual darts, throwing axes, escape rooms, all that stuff. It's just the way things are moving. Experiential leisure is growing. People want more entertainment. Those TikTok moments, the Instagram moments, all that stuff. It's embedded in there. So, yeah, I see this again. Sentiment is down across these kind of companies, but it'll bounce back. I think. I don't know how long it will take, but as long as the economics keep improving. And even if the share price stays what it is, it becomes, a better investment. So,
but you've done pretty well out of it anyway, because you bought it at the pandemic lows, didn't you?
Yeah, exactly. So, but
how's your portfolio doing?
It's I think when I've last talked to you, I try not to look at it too often, but I think for the last year at 20% down. But again, it hasn't gone down that much. I've had a couple of little rallies, in certain things. So again, we are seemingly hitting bottoms. Now, bottoms not formed; they don't V-shape. But a V-shaped bottom is bad, so you don't want that recovery like the recovery we had, in 2020, which was ridiculous. That sell-off.
It's not bad. It's just unlikely.
Yeah. It doesn't sustain it. It may take a while to roll over, but I think what we need here is like that S&P I was looking at yesterday has to retest those lows and maybe have a higher low, and then It'll take a couple of minutes. It doesn't happen overnight. It takes months to form a bottom properly, and then that's a good base to form off. So
how many stocks do you have in your portfolio?
6, I think. Yeah.
Okay, 6. And how much cash do you have left over?
Nothing really.
Okay, so you got no. Okay, yeah. I mean, all I would say just on that portfolio construction, and this is personal.
7.
7, yeah. 7 is a bit short in terms of if you've got a full portfolio with only 7 stocks. That really doesn't give you a shed load of sort of like diversification. I mean, I've got about 14, I think 13, 14, and I'm pretty low in terms of sort of my overall diversification. So if I was going to say to investors when it comes to constructing, if you want to sort of like you can sleep reasonably soundly at night, look for sort of 15, 20 maybe of well-researched companies. Or it all depends on how much risk and reward you want to take on. And I know you're very happy to take a lot of volatility, but when you've only got 7, in terms of you've got to be prepared, you're going to take a bath sometimes. You're going to have some really nice winners, don't get me wrong, but you're going to see that real sort of like whipsaw effect. So it's not 7, and certainly probably mine as well. It isn't with those low numbers of stocks and that concentrated portfolio. Yes, overall you do very well and make good returns, but you've got to have a very, very thick skin to be able to run that long term.
Yeah. No, I'm listen. I'm happy with where it is. I mean, I understand it's been a draw. It's been one of the hardest markets. Let's be honest. I mean, almost in August, the AIM 100 has hit its peak in September last year, and it's pretty much been, in fact, going back to almost a year now, it's been going downwards. And I said we are near a bottom, but I'm happy with this. And a lot of them, I just think, if you look at the valuations on them, most of them are fine. It's not as if
I'd be
worried about if they're overpriced and overvalued right now, but they're not, And so no, whenever I listen, I would not advise.
Could I just give you a scenario, right? You wake up in the morning, right? Yeah. Your biggest holding, I don't know what that is, 15, 20%, suddenly goes bust. It shuts doors for whatever reason it is. It just does it, okay? Because you've seen that going forward. And all I'm saying is that if under that scenario, which does happen, is unusual, an investor needs to be able to ride through it and to take that. And you can only do it once that's actually happened. You only really know you can stomach it once it's happened. And I'd be on the side. Don't get me wrong, I'm not saying you're wrong, Justin, because I've got the same situation. I've got some big positions in my portfolio, but I've been there before in terms of I've taken those, and it really is painful. Really is painful. And most investors who listen to this sort of like program will not have our level of, nuts, I was going to say, resilience, so to speak, and prepared to. So yes, it's all good running really concentrated portfolios. It's nice when things do well, like Equals and Northbridge, which I've got. But if I wake up in the morning and they've shut the doors on one of those, which would be really unlikely, but it happened because it's happened to me before, you've got to basically take that and move on and be prepared that you're going to be stupid, humble, and you've lost a lot of money in about a nanosecond.
Oh yeah, listen. Whenever I go through stocks, I mean, I have 9 filters I go through, right? I mean, and they have to be stringent, and I look at everything, and I even have spreadsheets looking at.
You don't, Justin. You can't look for everything because I don't look.
No, I'm not saying look for everything.
You have these tail risk stuff.
No, hang on. I'm not saying look for everything. I know I've got spreadsheets even on portfolio, sort of diversification, all that. I look at that and I say this over and over again on a weekly basis, pretty much, to club members. I said, listen, it's all about risk reward and your appetite for it. What can you take? Because and I've said this, your exact thing right there. I say, if you hold one stock and you're so convinced about that stock and you wake up in the morning, it's gone bust. That's it. You're wiped out. Simple as that. Now, I say I'm more comfortable with 5-10 stocks. Yes, but personally, if you're new to this and you want a bit of microcap upside, but you want diversification, I'd go for a good fund, first of all. I'd have that take up about 60% of your portfolio, because if you're new to it, you need that. And then picking about 5 or 6 stocks outside that, looking for
Yeah.
more upside. But
Okay,
I
makes
wouldn't do what
sense.
I do. I wouldn't do what I do because I've been doing this for longer. And literally, I don't invest in companies just overnight. I take ages to research them. And literally, I go through everything. Of course, you may have a left field event that happens, like what happened particularly with Valerie, where the CFO is doing something they shouldn't be doing. That can happen. Very rare.
Well, look,
It can happen, you know.
yeah, but look at the Ukraine Russia crisis. I mean, we've got another black. You know, that happened, right?
Yeah.
The Russia stocks, just on Russia stocks, almost a lot of them went to zero, or not.
And that's one of the filters. That's one of the filters. I think
they dropped 90% within about 2 or 3 days.
That is one of the filters in my I don't hold any stocks outside the UK. I will not invest in dodgy jurisdictions.
No, these are Russian. These are stocks with major Russian interests traded on the UK.
Yeah, I wouldn't hold anything like that. I never would hold anything like that.
We're on the same page anyway.
Yeah. So literally, I mean, I get just an example. My first 3 filters are growth, valuation, and profitability. Okay, then those are the core things. You don't fit those, they don't go any further. Next few are like trends, basically, the mega trends and scalability. Then after that, I look at jurisdictions, shareholders. I mean, jurisdictions, I'll just count it straight out. If it's based in Africa or exploration of Africa, Russia, anywhere. There's maybe not, parts of Europe even very dodgy.
Yeah, okay.
But so I wouldn't even look at that. So when I look at companies, I mean, they've got to have.
They can. I mean, I was just using that as an example, but there's lots of stuff.
I'm not jumping in. So I mean, if I one day I'll bore you senseless and take you through all 9 filters. But I mean,
no. But your filters can be your filters can be great, mate. But all I'm saying.
Yeah, but left field events can happen anywhere, and you can invest in. You can do all the research you want, and if you've got a dodgy CFO somewhere, cooking the books, you're knackered. I mean, you can.
There's lots of things like that as well. So just finally, one company I know you own, which is Space and People.
Yeah.
Just talk me through the suspension on the shares on that one.
Oh yeah, so in the AGM they were announcing a consolidation 10-for-1 shares, and also that was passed on the votes, and then they're suspended. So I did email the CFOs.
Really weird that. Really weird. I've never known a share to be suspended on a simple consolidation of the share capital. Really strange that is.
Yeah, but they announced today this is fine. I mean, the technical.
They're trading again? Are they today?
Yeah, they said they announced. Let's have a look here. They said announced today about it. I mean, the CFO go back. Don't worry. He said there's been a technical issue with consolidation. But it's happened now. So they've confirmed.
Okay.
The issue. Yeah. So I don't know what happened.
Okay, so it's back up and operation. Yeah, I've learned something. That's a relief. That is.
I know. I did have one of those futters. I mean, it doesn't take up a massive part of my portfolio, but even so, you think, what the heck's going on there? Because last time I spoke to the guys, the business is getting better. It's trading fast. They're really improving very well. So everything's going in the right direction. And they're very happy with how things are going. So what's going on here? So okay, that's fine. It's all right. It's a technical issue, boring technical issue that it'll be sorted very soon. But they're fine. But you do one of those heart flutter moments. Think, what the hell?
No, I agree. When shares are suspended, it's usually wow. That could be serious stuff there. We'll wait and see. But anyway, that sounds like it's all sorted. So just to end in now on a positive note, what will happen this afternoon? We're both basically, sort of like guessing what the print is going to be on CPI in the afternoon, but bringing it down to the nuts and bolts, what will the market do? My view, is that if it comes in within expectations, it's ho-hum, and you'll see the gains, the losses that we took last night will basically be recovered, so it will actually increase. So if it comes in about, sort of like headline, roughly around about 8.3 and core around about 6, then in my view, the market will rally a bit this afternoon, okay? If it comes in really hot at about 8.7, 8.8%, etc. It will obviously take a negative reaction, but actually, I think what will occur is that once that data is absorbed by the market, a lot of these professional guys next week or the week after will start coming back into the market. So I think you'll get initial negative, and then you'll get a bit of a bounce probably towards the back end of next week. And if it comes in a lot lower, then it doesn't hotter, then it all really then depends on why is it coming a lot lower in what particular areas, and whether it makes a meaningful difference. But if it is relatively, it's a proper benign reason that inflation is coming down, then it's going to rally, and it should rally reasonably strong. So that's what I think will happen this afternoon. Let's wait and see. It's a total guess, but all scenarios say to me is that you don't want to be selling ahead of it. You don't want to be sort of like taking a too bearish approach unless you are convinced that we're going to see a deep and protracted recession, which is a possible, and we talk about this on the tail risk. And if it is, then I mean, I've got less than 2% cash like you, and you know, my portfolio is going down, but you know, one of those things.
Yeah. Do you know what you said there? I was thinking exactly the same. I think the initial reaction will be different to what the markets react to a bit longer term, of a couple of weeks. I think if you get an initial flurry of uncertainty at the start, and then something comes out, oh, you got a lot of trading activity going on, and we've seen this before. You have a rally, then it comes down. If it rallies, it may come down lower later on. But if it drops a little bit, it may actually rally later on when people actually break down the figures. Think, in fact, there's some signs here.
Yeah,
you know,
it's subject to what I think is. The market is already negative on going forward on the economy. Okay, it's seen it coming, right? It's offside. It wants to get back in, which is great. But that's what the market is baked in is a shallow recession. It hasn't baked in a severe deep one. If the data comes out that convinces everybody, actually, we're going to get a deep recession, the guys on the sideline ain't coming back into the market quickly. No chance. They'll wait it, and you'll get more people dropping out, so it won't come back. But I still think the probability of a deep global protracted recession, particularly with China stimulating, which is the second world's biggest economy, is still low. You know, I still think that's a sort of like 15% less type of stuff probability, but it's a possible.
Yeah, because
you could get it since the oil and gas, you know, accelerate further from 120 a barrel, and on that basis, that could really give us a global recession because consumers, you know, effectively, you know, not only cut out discretionary spend, but cut out just about everything. Don't go to boom battle bar.
No, and fear breeds fear, doesn't it? When you get people,
it does,
and then it exacerbates the situation. Marvelous stuff. Thanks for all of you watching this on YouTube. Don't forget to hit that like and subscribe button, and we'll speak in a couple of weeks, Paul.
Yeah, take care, matey.